Hi everyone, welcome to the final panel session of our Prospectus 2021 virtual conference. It's been a marathon session for me over the last few days, but I'm delighted to be joined by some more people I find really interesting to talk to in the industry, and we're going to be discussing a technology-leaning sort of side of reinsurance, and we're going to discuss how advancements in technology are set to drive better reinsurance outcomes for market participants on all sides of the deal as well. It would be remiss to focus on one side and not focus on the others as well. And obviously there's gains to be made for everybody by using technology within their businesses. And in this year where we've all been forced to work remotely, that's become perhaps more apparent than ever, and the industry's actually adapted reasonably well to that, but we'll hear more about that as we go through the session. Delighted to be joined by Sean Bourgeois, CEO of Tremor Technologies, Claude Yoder, Head of Analytics at Lockton Re, and Carol Pierce, Senior Director of Insurance at Kroll Bond Rating Agency. Thank you all for joining me today. Looking forward to this discussion. Going to fire straight into the questions. Oh, and a quick reminder for the audience that you can ask your questions during the session. There's a box on the screen in front of you for Q&A. Please don't be shy. Ask anything you feel might be relevant to this conversation, and we'll try and get to it at the end. But perhaps we could start with a view of where we see the industry right now from a point of view of technology maturity, and particularly focused on the reinsurance end as well. There's been a lot of discussion and noise around insurtech over recent years, some companies much more advanced than others. But when we think about the reinsurance market, technology platform as a whole, how far along actually are we? And we're going to begin with Sean Bourgeois from Tremor, please.
Great, thanks, Steve. Great to be here. So I think safe to say we're in the very early innings of how technology can really help improve the reinsurance industry in particular. I think phase one was sort of dominated by third-party technology companies that sort of enabled or tried to enable straight-through processing, and then other companies that tried to enable bilateral negotiations and so on. It's our view that those aren't really technology problems. It's marginal improvement at best. In most cases, probably a bit of a tax on the system, frankly. And the brokerage intermediary layer does most of that very well. So that, I think, was kind of a sort of false positive that was low-hanging fruit perhaps, and folks chased it. Really now I think what we're moving into, though, is true deeper technology that can fundamentally improve execution. Of course, from our perspective, marketplace technology, we believe, can really do that very well. So we're able to gather very complex price information and work with brokers and cedents to figure out, what should the best, most competitive clearing price be. And by the way, for reinsurers and ILS funds, give them an opportunity to offer their capacity exactly how they want to as they're building their own portfolios. So we think the market generally is moving from kind of this mirage of improving tech with a little bit of sort of a shiny interface to much more deeper fundamental technology that we've seen really power other industries forward, and we're really excited about that.
Sure, thank you, Sean. Yeah, no, it's interesting how there's definitely a bit more of a focus on some of the core fundamentals of technology that can really make a difference, rather than just applying user interface to existing process in the industry right now. Claude, from your point of view, working at a reinsurance broker, I'd be interested to hear what you think about the industry's sort of maturity when it comes to technology.
Yeah, sure. Thanks, Steve, and thanks for having me. Yeah, I mean, I think that one thing that's very prevalent is just how diverse it is in terms of how companies in the marketplace, whether it's a carrier, a broker, a reinsurer, are approaching this opportunity around technology and analytics. And a lot of it is trying to find, as Sean alluded to, more modern means of using technology. But I think it also gets into other aspects in terms of what your overall strategy is. And I know we'll talk about this in a little bit more detail, but buy versus build strategies, the use of partnerships, things of that sort, especially as insurtech has entered the scene and you sort of have on one end of the continuum insurtech startup companies with a lot of capability, a lot of innovation and thinking on one end, but maybe with a little bit less understanding of the industry. And then on the other side, you have well-established, decades-old companies that are dealing with legacy IT and trying to find a way to move all of that forward, right? So it's a lot to consider, I think, both in terms of what that typical stack might look like, which simply said would be sort of the data at the bottom, the analytics in the middle, and the consumption or the visualization at the top, on one hand from a functional perspective, and then looking at the different processes that exist to move a piece of business, from the one side on the carrier side, let's say, into the reinsurance side on the other end. And so putting that all together is reasonably involved, and we see a lot of companies dealing with that in different ways. But I also think it's easy to lose yourself in a rabbit hole as you go into that framework that I described, where you see people pursuing different things that might be looking or insisting upon almost doing something like automating all of the data that you receive from disparate sources and creating more of an automatic or using artificial intelligence in some fashion to try to do certain tasks that once you look at them in more detail, you realize that the pursuit of that thing is not necessarily a first order issue, or doing it and insisting upon a certain approach will not ultimately get you to where you need to go. And so being this marriage between, I think, the knowledge one might have of the business, the processes, what's required on one side, and then the technology advancements and the use of that technology, marrying those things, and I'd say creating some very reasonable and yet appropriately innovative approaches to move the ball forward, will be the ammunition that companies who I think start to differentiate themselves will use to do that.
Thank you, Claude. Moving on to Carol, your position at KBRA, you analyze insurers and reinsurers, you look at their credit worthiness. How is the sort of current wave of technology adoption factoring into your view, and are you seeing the kind of progress you'd hoped to?
Well, I think, as my fellow panelists have said, it's really evolutionary. But what we at KBRA are primarily interested in how any of the technology is adopted by a primary company, a reinsurance company. We're really looking to see how that advances the company's management of risk. Because at the end of the day, our ratings speak to the long-term financial strength of those companies. And if they've issued any debt to further their objectives, then it also speaks to the probability that bondholders are going to receive timely payment of principal and interest. So I think we're on a continuum, and I do believe that a lot has been done, a lot has been tried, a lot is ongoing in that process across the industry to make the entire process of insurance easier, all the way from the applicant, to retrocession at the other end, efficient, less subject to human error. And that's all definitely beneficial from a credit perspective. But what I'd like to see, and I'm not seeing as much, and we talked a little bit about that, is that companies need to then turn their attention to improving what's going through that system. So oftentimes I talk to companies and I ask them, what's the reality of what you're looking at? And underwriting might have a view, and claims might have a view. And after the loss comes, maybe the view is slightly different. So I think we need to get to a point where there's a view of risk that a company is assuming. It doesn't matter where in the process they happen to sit, but that they're actually getting accurate, comprehensive, unbiased views of what that risk is. And I don't think we're quite there yet, because we wouldn't have companies reporting poor results if that were the case.
Absolutely. Thanks, Carol. Yeah, no, that's interesting as well, because obviously the inputs to the business in insurance and reinsurance are the risk itself, and how you understand and visualize that is then going to flow through the stack, as Claude called it, and affect every piece of that. And if InsurTech is been very focused on some certain specific areas of that stack, perhaps the gains aren't going to be made without addressing the other blockages within that. Sean, have you got any thoughts about that, about sort of how legacy perhaps holds back some people, while on the front end they're maybe spending quite a lot of money on InsurTech projects?
Well, I mean, I guess it's fair to say that there's still a bit of a shiny halo around InsurTech, generally speaking, and it's kind of that checkbox that a lot of folks are looking to check to try to track tech and bring it into their organizations. And, there can be these shiny objects out there that seem like they can really be helping. But in Carol's point, it's sort of like, at the end of the day, it's probably just marginally improving a process, but it's not necessarily bringing better insight or pricing capability to the organization on either side of the transaction from a reinsurance perspective. So I do think, that's sort of my comment about deeper technology in general. Tremor as a company is focused on the marketplace component, so pricing, syndication of risk. But for us, the best case scenario is the trajectory that was just mentioned, that as risk becomes, data that a company's risk becomes more robust, folks in each company have a more uniform view on that risk. And ideally, there's sort of a uniform perspective on what a portfolio would cost at various quantities and various subjectivities. That's wonderful for us, because that just allows us to clear the market even more efficiently. So to your specific question, Steve, I think, yeah, there's probably been a lot of kind of front end sort of glossy sort of interface work and that's been done. And that's okay, like that's natural, but the next phase has to be more substantial investment and more substantial adoption of technology that can really move the needle, can bring transactions from months to minutes and price properly, particular to each company's portfolio requirements.
Yeah, I couldn't agree more, Sean. That's certainly where the industry needs to be moving towards. Claude, don't know if you've got any comments on that specifically around sort of how the industry, whether the pipeline within the industry itself is up to consuming this data yet and making sense of it.
Yeah, I think it is increasingly able to make the right considerations. I do think, though, that framework that I was describing, where you have, we'll call it technology advancements, but across that stack, simply set of data informing analytics, compelling a certain way to then consume the outputs, right? The insights that are being generated from that on one hand, and then against all the various processes that go into moving a risk, ultimately to transfer that risk to a capital provider. You need to consider what can be done, and I think that there's necessarily a need to understand the nuance in those things. And so this marriage of and again, not to spend too much time on this dichotomy between InsurTech on one hand and the players in the market today, but there needs to be sort of a marriage of all of that great technology wherewithal and innovation on the InsurTech side and the knowledge that the industry has on the other. It's easy to say, but I think in my experience, it's very difficult to do. But I do sense that there are there's a lot of progress that's being made to create the right marriage. I do think that legacy IT piece does play a huge role in this, though, because even if you want to go and adopt a certain InsurTech, let's say, generated, and it doesn't have to be InsurTech, it could be anything, but let's say you want to adopt an InsurTech related piece of capability within your stack, within your architecture as a well-established, decades-old company, it it sounds easy to do, but it's really not, because there's a certain amount of reconfiguring that existing architecture to make room, if you will, for the new piece that you're going to put in. But that modular thinking, I think, is starting to gain traction. It's just that how do you do that? How do you take a best-in-class capability that realistically you, as more of a, let's say, a legacy player, are never going to be able to create at the same level of quality, but how do you incorporate that into your much larger and typically very customized architecture, right? It's a difficult thing to do. And I think people are wrestling with that, and you see some starting to make progress and others, still in that process of considering how best to do that.
That's a very interesting point as well, Claude. Having worked in an industry where people use sort of 35-year-old code and systems, I know the insurance and reinsurance industry is very similar to that. And these things take time to unpick, and they're difficult to then plug different systems together as a result of that. And while we're on this subject of sort of the type of technology people are using, Claude, I'd like to know, you're at Lockton Re, you've been investing heavily in technology, building, I think, as well as perhaps using other best-in-class technology where you can find it. But perhaps you could talk about some of the benefits you expect that to bring to yourselves, but more importantly to cedents and also to the markets that you're bringing those cedents to.
Yeah, absolutely. So it sort of builds on what I was alluding to before, where, like most things, there's an appropriate amount of balance that I think helps optimize the solution. And that doesn't mean, you do 50% of the one thing and 50% of the other. It could be 10-90 or 90-10. But having only one represented, if you will, would probably not be the optimal outcome. It is challenged by that, the more legacy IT you have, the more difficult it is to go and buy the thing and then incorporate it into your stack or into your architecture. So you end up in this sort of vicious cycle of continuing to build, right? Enhance, build, deconstruct to try to erect new things. But I do think, in our case, we have much more of a greenfield. So it's been our mission to try to really partner and buy things, if you will, that make a lot of sense to then create more of a modular componentry to build our platform. Having said that, we also invest quite heavily in our own resources, so the build part is very much alive and well. But if you can use a more modern approach from the software itself, from the hardware itself, from the people themselves, in terms of their understanding of the technology space, which is incredibly dynamic and difficult to keep up with unless you're very much in that space. You can create a team that is not monolithic, or it's a small army, if you will, a small group of people that then interact with other partners that you're trying to buy from, to use this buy versus build metaphor, and that helps to stitch these things together, and I think create the best possible outcome, right? Because it only makes sense that what you see with certain types of capabilities that are out there, let's say again on the insurtech side, you're simply never going to be able to create that. You'd have to have, the funding and the resourcing that insurtech had to create it in the first place. So how would you ever get there? And then multiply that by hundreds of different capabilities. So, doing a certain amount of the build, or buying rather, I think is necessary, certainly to optimize, if not actually exist over time. But it also has to be married with the right internal team to be able to do what they need to do.
Sure. Thank you, Claude. Moving on to Carol, what's the rating agency view on sort of buy, build, and spending money on technology? Is this something that you're factoring into your thinking when looking at somebody's creditworthiness? And there's been some quite significant investments made by some players as well, which obviously aren't things that are transparently reported in their balance sheet reporting either. So do these things concern the credit rating agencies?
Well, I think from a pure buy, build, insurtech standpoint, I really think the rating agency is agnostic. But I do agree with everything that Claude has said about these legacy systems. And as an industry, you know, we've historically tended towards building these big proprietary systems in the belief that it gives us, the company, a competitive advantage because it looks at the world through our own individual lenses. And, you know, even when I talk to relatively small companies that are buying things off the shelf, they're making lots of customizations so it's theirs. This just makes it incredibly challenging to update systems when new technology comes along, or even just a simple upgrade sometimes is a challenge. To get the you know, best outcome for you, because at the end of the day, that spending, which it is an expense that's going to eventually show up in your income statement and your balance sheet. It needs to advance your business. And at the current technological change, I think, you know, what Claude has suggested about you have sort of your core piece, but it needs to be on a platform where you can plug in a module that is going to really advance your understanding of risk or improve the efficiency of your operations. Because somebody out there is developing all these things at a very rapid pace. So I'm not sure this, you know, steeped in legacy systems, which I still see some companies very much holding on to, is going to work. It's not sustainable over the long term of the future. And even for large companies where it may be sustainable, I have to question whether or not that money could be better used someplace else in the organization, maybe at the analytical or at the visualization end of things, or just in getting a more integrated view of risk. You know, I think reinsurance and insurance companies need to start thinking along the lines of what are we best at? And there are lots of developers out there that are really good at what they do. And I think it's a question of marrying those different aspects into a comprehensive whole that helps you move your business along and helps you manage risk better.
That's some great points there, Carol, actually. And it kind of brings home the message that not everybody in insurance and reinsurance needs to be an insurtech themselves. There's plenty of people out there who can help you be or become an insurtech in the way you deliver your products. You don't necessarily need to spend hundreds of millions on developing your own systems to do that. There's plenty of things out there to help you get there. Sean, moving on to you as the only sort of insurtech representative on the panel. You've obviously built a platform that promises benefits for both sides of the transaction, and importantly also for the broking community. Can you talk us through sort of your thinking or your thesis as it stands today on sort of how tech can drive efficiency into the actual reinsurance transaction itself?
Yeah, I mean, I think it's really two dimensions. It's price efficiency and cost efficiency. The cost efficiency is kind of straightforward. It's kind of easy to understand when transactions are taking potentially months that could take minutes. You know, just by simply compressing how that transaction is being executed with technology is a great win. But really, from our perspective, the part of the market that we believe should trade so-called programmatically really gets a lot of price efficiency. So best execution in terms of figuring out what should the perfect clearing price be for a particular portfolio, given potentially a large panel of reinsurers and ILS funds that each have their own view of, you know, what their portfolio is today and what it will be tomorrow. For each individual fund or reinsurer, they're going to have, and they should have, a different view of what the price should be at various quantities for a particular portfolio and different subjectivities. So because that's a very complex dance that happens in the market for, you know, particular types of risk, that's where we see you can have dramatically better price efficiency, which benefits everyone, which benefits the cedent and the broker, and benefits the reinsurance capacity side of the market as well, in our view, for many important reasons. So really, that's what we get most excited about is really step function change to both price and cost efficiency. So the point of friction in the market is where we think tech can really deliver the most benefits for everyone.
Absolutely, and it's not just about delivering benefits in the efficiency layer in terms of cost. It's making their jobs easier, but making the actual transaction more effective as well in terms of price and in the future coverage too. I would hope the use of technology in reinsurance extends into creating better products with technology as well. Claude, moving on to you, where in the stack or value chain do you see the greatest opportunities to help your clients, both the ceding and the market side, to improve the outcomes of their sort of interactions?
Yeah. Well, I think, again, we'll go back to this three-layer metaphor of data analytics and the visualization or consumption thereof. And I mean, I think it's fair to say there's quite a bit of opportunity in each one of those, maybe not equally so. But, on the data, if I take each one of those quickly, for data, I think one of the things I've witnessed in my career is that it's difficult. It needs to be unpacked a little bit in terms of what we mean by data. Big data had been a buzzword for many years. I hear it used a little less often now. But the nature of the data, the detail it contains, and ultimately the things you can do with it, right? The value and insights that you can create from it are not all created equal. So the idea that, there's a lot of data laying around, it's big, if you will, and therefore you're in good shape, needs to be examined in much greater detail. So this and then it's the data of a form that it's easily connected to other types of data. And at what level, at what grain, as they say, would you be doing those types of connections? So even if you have a very useful set of data that's, let's say, siloed and therefore is difficult to integrate with other sources of data that really bring it to life, right? That create a whole that's greater than the sum of those parts. Can you do that or not? So I think there's a lot of opportunity, again, to unpack that. We've certainly done that within Lockton Re, and then say where can we spend more time and energy making sure that particular type of data is well represented, because it will provide insights and value for our customers. On the analytics side, I think that there's a lot of good analytics that exists now and has existed for many years. But so if you look to then increment that, I think it's actually in some ways a little harder than data. And you need to be smart about what that means. Certainly you have to have the typical kit. The typical approach is it's still very sophisticated stuff. It's not going anywhere. It will always be used to some extent. So how do you implement that? And we feel that there's ways, again, to take certain notions out there, like optimization as a notion, but not necessarily do it in the academic sense of the word, but in more of an approachable way, a reasonable way that allows you to create more options, a more comprehensive view, let's say, of structuring options for our clients, right? And so again, I think this marriage and this balance I've been describing is important there. And there are ways to do it, but you have to be sort of smart about how you implement that. And then, of course, on the visualization and consumption side, I still think people shortchange that. But if your current means of delivering what is a lot of sophisticated thinking is on PowerPoint, for example, then you're probably not doing justice to the much more modern, the much more meaningful, interactive, intuitive ways that you could deliver that type of information. And, we've invested heavily in that particular space. So I think there's opportunity across those three components. Absolutely, no doubt. It's just a matter of where, you decide to focus and what provides the greatest value.
And data comes through as a core piece of that in your comments there, Claude. And it's interesting that obviously the industry went through a big phase of data collection sort of 10, 15 years ago, and often found that they didn't really know what to do with that data or how to interpret it sort of effectively. And the amount of data doesn't always matter, does it? It's the skills and the tools that you have that allow you to interpret that, visualize it, and put it to work within your product and your business. Sean, any feeling from you on sort of where incumbents can most effectively insert this technology, particularly this deep technology you talk about, sort of into their own value chains?
Yeah, I mean, I think it's important that they do so within their own value chain, within their own process, and in such a way that's a pretty light lift. You know, it was mentioned earlier in the conversation that many insurance and reinsurance companies are investing huge sums of money, potentially off-the-shelf buy or build internally, adapting what they bought, and so on and so forth. And I think that the key is keeping that rather process-specific and light as much as you can. And this is where, you know, extensible technologies like a company like Tremor can be very helpful, because we're not requiring a mass normalization of all kinds of different data to even begin to use the product. We're abstracting from all of that. And if you abstract at the right level, you're able to allow both sides of the market to fundamentally work as they do, but really take an important part in the middle and shrink it and make it happen much faster and much more efficiently. So from our perspective, you know, from both reinsurance providers and ILS funds and buyers of protection, it's really focusing on that. Where can you invest technically and invest just, you know, technically thinking to be able to shrink that chain, not necessarily reinvent it, and certainly not pour more software and more technology, just putting a bigger tax on the system that just simply looks nice but doesn't actually add much value.
Absolutely, it's got to be all about value. And Carol, I was going to ask you sort of what are you actually looking for incumbents in the industry to demonstrate through their use of technology? Are you looking for them to grow their business with it? Are you looking for them to improve their results?
Well, I think fundamentally we're looking for them to better manage their risk and have a more integrated view across the organization, where there's one view of the truth and the claims. And after, so you see this a lot in companies where after, if they're writing catastrophe exposure, after a catastrophe, well, what the claims people are telling you isn't the view that the underwriter had when they accepted that risk. And that, to me, is a problem that technology can solve. You know, it takes a lot of work, as we talked about here, to get all these systems together and to get the data at the right level so that it can be matched up one to the other. But that's really what we're looking for in terms of their technology investments. Are they progressing along towards management that is more integrated into their day-to-day operations versus being something they do once a quarter, once a year, whenever? We really need to be using that technology to expand and enhance their view of the risk that they're assuming.
And that also would allow incumbents in the industry to improve the way that they share data as well, you would hope, which obviously should reflect on their results come renewals time in terms of having better relationships with clients and cedents. So right. Positives for all sides of the market by advancing their own abilities.
Right, that's one of the things that we do, particularly on the reinsurance side, because they are somewhat removed from that, you know, insured that's sitting perhaps in Florida or perhaps in California, wherever it happens to be. But they're removed from that intimate knowledge of that risk that a primary company has a better sense of, and perhaps the agent/broker has even a better sense of it. And because of that, one of the questions that I always ask is, you know, what are you doing to check on the quality of the data that you're getting in a submission that you're looking at? Because if I go back many years, it was always IT's fault that the answer came out wrong. And IT's response was always garbage in, garbage out. And we really haven't progressed. See, we've progressed a lot, but we haven't progressed all the way past that. And we now have technological advances and mounds and mounds and mounds of data that could help us get to that point where the quality of what we're looking at really does reduce the variability around the risk that a reinsurer is assuming.
Yeah, that's interesting. That brings to mind the thought that in some industries, technology has proved to not just be an enabler, but also something that levels the playing field. And sometimes perhaps in reinsurance, where you have lots of different companies of different levels of maturity and scale, it feels like sometimes the leveling of the playing field is not as desirable always as it perhaps should be. But at some stage, this really has to come with technology and development moving so fast now. Sean or Claude, I wonder if you've got any thoughts about that, about sort of the leveling of the playing field.
So, Steve, I was just going to add, we
Sure.
talk about the infancy systems and a lot of the big, well-established companies. In some ways, startup companies have an easier technological progression than some of the large, well-established companies out there, because they are able to adopt and build on a platform that is taking advantage of the technology today, so that they don't have to undo a lot of things that have been that are causing some of the established companies to have to rethink how they're going to approach using technology and helping it further their business.
Yeah, no, that's very true, and that's often where the fear of the startup comes from sometimes among incumbents in an industry. Sean, as somebody who's running a startup, although Tremor is becoming less of a startup and more of an established component of the industry, how do you feel about sort of the leveling of the playing field and how your technology can help incumbents to operate on a more sort of balanced playing field?
Yes, I mean, from our perspective, getting risk to capital most efficiently is what we're all about. So what we're able to offer to that buyer protection is an extremely efficient route to present that risk to as large a panel of capacity providers as they like to, and to have complete control over, how much potential allocation any of those partners could have. So there is an element of panel control if you want it. But if you don't, you can allow the market to compete. As you introduce more competition, you enable things like lowering lowering barriers to entry for outside capital and leveling the playing field, frankly. So we've seen that on many placements that we've run, that providers that had typically had to kind of fight tooth and claw for a couple of % line every year, suddenly we're allowed to compete a little more aggressively, really love the risk, fits their portfolio perfectly, and one more share because of the mechanic that we offer in the market. And that was good for them. It was good for the buyer protection and good for the broker. So all around it can work very, very well. So, I think the two things to keep in mind from our perspective that we've kind of learned over the last couple of years is you need to introduce the right level of competition that the buyer protection is comfortable with and the sellers of protection that are participating are comfortable with. We need to offer a marketplace capability that can be tailored to any buying experience, and that's what we offer today. So in terms of leveling the playing field, definitely, and it's sort of up to the buyer protection how much constraint, if any, they want to put on a placement.
Yeah, thank you, Sean. Interesting. So we're going to move on to talk about sort of accessing risk and I guess the origination side of things, and how do we feel technology is going to broaden the scope of opportunities for reinsurance capital providers? Claude, perhaps you could give us your opinion on that first.
Yeah, sure. So, I think the nature of this is to understand the risk itself, the nature of that risk, and then what means or structuring exists to transfer that risk, and against a set of metrics, right, financial metrics effectively, that describe the value that those two counterparties, the originator of the risk and the bearer of the risk, the capital provider, might have, right? So what lens are they going to take for both the risk itself, right? What does the inherent risk look like? And then, as we would say, on a gross basis, meaning in the absence of overlaying a risk transfer structure, reinsurance, and then the nature of the structuring that could exist. So that may all be obvious stuff, but I think that capital providers and the alternative capital, if you will, that exists, so moving beyond traditional reinsurance reinsurers into other investors in this space, what I see is that there will always be a bit of an art and science to those components. So in other words, understanding the risk, the structuring itself. It's not necessarily fully quantitative, and it certainly doesn't need to be fully judgmental or fully based on experience, the so-called art. And what I sense happening from the capital provider perspective, where alternative capital is a good example of this, is that, for example, in that case, what had been happening was there was a lot of property catastrophe related interest. And in part, it was because it was more formulaic, right? There were some standards in the way of output that was generated around the nature of the risk. It was reasonably easy to create some structures that could be the vehicle by which that community of investors would use to invest in it. And now it's started to expand into other risk classes. So it's interesting to watch it move from, let's say, property into casualty and into other non-property related lines. And I think in part it's because some entities within the marketplace are starting to do a better job of quantifying and using technology to help with that, what those components look like, and sort of carrying the ball as far down the field from a quantitative perspective, because that investor mindset is more used to a financial dynamic and the ability to quantify certain things. And so as technology and analytics helps move the ball further down that field, so where quantification moves, let's say, beyond the 50-yard line, and the art part of it, because that investor base might want to diminish that art part, if you will, a little bit less than other capital providers, you see the interest level from that investment community expanding beyond things that are naturally a little bit more formulaic into other things where maybe it will never be as far down the quantitative field, if you will, but it's far enough to essentially generate some interest from that group in terms of further investment. So I look at that as a good way where the playing field is being leveled, if you will, to bring additional capital, into the market.
That actually aligns very well with something that's being seen in the ILS market at the moment, where there's certainly a bit of a flight to simplicity in terms of structure and predictability of terms, named perils, all those sorts of things, that actually technology-led risk transfer solutions will probably drive a greater standardization in future as well. Do you think that eventually we get to a stage where capital markets can participate more readily thanks to technology?
Yeah, no, absolutely. I mean, that your sort of simplification comment is a good one, Steve, because I do think at times, I mean, if you unpack just the suite of terms and conditions that may exist across, the superset of all different kinds of contracts, I mean, it would be quite a tome of information. But I think when you unpack that and you say, but which of these are truly meaningful, and this is where the quantification sometimes is difficult, an hours clause or, things that are speaking to certain types of exclusions, can we do more to say, is it really worth all the time and energy to create language and contracts and different things that address that particular issue? Or can we agree that we start to strip out certain treatments so that it is more simple? And if it is more simple, then it lends itself more to standards, to greater understanding, and you do see some movement in that direction. But that sort of nexus of stuff has been one of the greatest things, I think, holding the industry back from greater and more quick innovation, because there's always sort of a, but, you know, that deal has the X, Y, and Z clauses, or did you consider this? And sometimes it may be relevant, but it does start to stand in the way, I think, of simplification and standards and things that will really help us move forward and let technology what it can do best.
Yeah, absolutely. And also things that would help us to move greater volumes of risk ultimately as well. Sean, I wonder if you've got any comments on that sort of topic as well, around how standardization through the use of technology could actually help to increase throughput eventually for the market.
So I tend to think that most capital providers, so folks that call us that say, hey, how do we get involved in your market? As you know, how do we buy risk? And then they're outside the market. They're not necessarily focused on standardization. They're focused on, can you give me good diversification? And can you give me, or someone, give me the distribution of losses that are expected? If you can give me those two things, sign me up. I'm ready. And so the marketplace capabilities that we're building at Tremor enable those folks to have a seat at the table. It's early days for us to offer them the diversification they need. It's our view that there'll be wonderful models created where that risk can be priced efficiently on behalf of those folks, with far fewer hoops and hurdles that folks have to come over to participate in the market. So you kind of need that nexus, that marketplace hub, to allow that type of capital to have a seat at the table. I don't think there's so much clamoring for, you know, we have to have this completely standardized and tradable, and we need a secondary market, and so on and so forth. Yeah, sure, that stuff will all come. You know, we love that future too, but there's a lot that can be done before that, in our opinion.
Yeah, that's interesting. Thanks, Sean. So, Carol, turning to you now, one of the things that I've written about a lot over the years is how sort of technology could help to make reinsurance capital more efficient, more elastic, more effective for people, and help reinsurers or indeed ILS funds to do kind of more with less over time, which plays to the overall efficiency of the market and the directness of matching that capital with risk as well. Have you got any thoughts there from the rating agency perspective? Do you think that advantaged or advanced access to technology is going to become a real differentiator for companies in the market?
It's hard to say. I'd like to continue on the conversation you just had with Claude and Sean, because I think one of the issues, having worked on a couple of structured transactions for insurance risk, is that non-standardization of clauses. Because if I look at other things that are placed out into the market that capital providers want a lot of, the contracts that are underlying those, like auto loans, are very standardized, and reinsurance isn't. And that's been the big stumbling block that we've had in trying to get some of this stuff, like in the case of trapped capital, some of it, you know, put back into the capital markets so that capital can be used again. So that's been, that is something that I think has been difficult in getting capital and risk together. And the other thing that Sean talked about was, you know, people coming to him saying, if you do the distribution of risk. But that distribution, again, goes back to depending on, you know, what's going into getting to that distribution. We have a tendency to think of things that come out of technology as being the truth, when in fact we really need to go back and look at how did you develop that distribution. So I think those are things that need to get further developed. And I think that's one of the big challenges for a lot of the capital providers, is getting comfortable in an industry that has a lot of things that have developed over time and are standards within the industry, but not necessarily in the capital markets. So I don't think I answered the question.
You didn't, but that's a good point anyway. So maybe I'll turn Carol's question over to Claude instead. Do you think that sort of advantaged access and the ability to create your own technology is going to become a real differentiator for the reinsurance market, perhaps at renewal time, for example?
Yeah, I think I go back to some of the earlier comments. I mean, I think that everyone is going to want to have something they do that's at least a little bit different. I would like to think that underpinning that would be a certain amount of standards, not for the sake of standard setting per se, but for what the promise it holds, which would be to allow all of us, if you will, to do more with the same. You know, the amount of inconsistency with what we deal with is one of the greatest things that's holding us back. But and then if we had that, it would just, anything that anyone did from that point forward would be better, if you will, than whatever they're currently doing. And so then differentiation works on a much more solid foundation. And so, again, an appropriate amount of standards. And I think that's where it becomes difficult, because there are so many things that you could dig into. And it goes back to some simplification ideas and so forth and so on. But I'd like to think that everyone would benefit from a certain amount of diversification, and the real winners, I guess, if you will, would be the ones that differentiate in the best possible ways, that attract the most customers, and by definition, I suppose, do create the most value. From what I've seen, I think it's sort of like the bad news is the same as the good news, which is there's tremendous opportunity, and the reason that opportunity exists is because I think it's been challenging for the industry writ large to do things, and where standards and consistency of approaches and so forth have been difficult to come by. I think we're starting to make some progress, although I think it's still challenging to do that. And because that foundation, if you will, doesn't exist, it does make it harder for everyone, whether it's that insurtech company, carrier, broker, reinsurer, to differentiate, in part because they're spending so much time dealing with all of these different data sources and means to extract the data, and their own internal systems potentially. So I think more work will have to be done on that to really allow some of this differentiation to take place. But I don't think it has to wait on it. I think that's part of the issue at times I hear is people will say, well, we're waiting until such time as those better standards exist. And we've been at it for a long time, I mean, decades. And progress is being made, but it's slow progress. So I think you look at the reality of that somewhat slower moving train and you say, how can I differentiate and use what's there now and work, that end against the middle, if you will. So there's a lot of opportunity, though. There's no doubt about that.
Sure, and I guess go on, Sean.
I was just going to follow on that point. And, we largely agree. And we've run periodically an ILW market with 4 fixed structures with a set of terms, swap format, reinsurance format, all comers, line seal bidding. That can be effective in that scenario. But trying to standardize more than that, I think there's just a large graveyard of companies the last 30 years that started there. Just, okay, we have to standardize everything. And they all end up with the same fate. And part of the reason, in our view, is that issuing the risk to buy and hold capital can be dramatically improved, abstracted. You don't need to standardize everything to issue the risk much more efficiently. When you're talking about a secondary market, of course, absolutely, things need to be standardized. But we just see, so much opportunity to issue the risk much more efficiently with technology that we will tackle secondary trading when it comes. But for now, it's kind of our strong view that that's where a lot of folks get tripped up, that we have to standardize, and let's go ahead and standardize. And then it's a never-ending, really big rabbit hole you're jumping into when you try to do that. So our view has always been, can we abstract it to bring value. And then ultimately, at some point, there'll be a really healthy, robust secondary traded market, which at that point, we have to really think about standardization. That's been our view.
Sure. And I guess at this stage of the industry's maturity, it's about finding ways to allow the industry to use technology effectively that gives them proper gains rather than trying to propel the industry forwards 20 years in one step.
Right.
And what do you feel about sort of frictional costs, Sean? Well, I mean, obviously technology adoption in the industry, reinsurance and insurance as a whole has been using technology for decades, but in some areas still quite immature. I mean, thinking much more broadly than just the technology you bring to the marketplace. Do you think the industry as a whole has got significant gains to make in terms of frictional costs?
Yeah, I think so. You know, more risk, more often, more dynamically, pricing it exactly as you want is where the world is going to go in the risk market broadly, reinsurance, insurance, anything through wholesale commercial, where there is any element of syndication. So, you know, we think that we're in the extremely early stages. If you know, anyone from the outside the industry looks in and sees eye-watering expense ratios, you know, you don't have to go much further than that to realize that, wow, there's a lot of opportunity here to transmit and transfer this risk much more efficiently, at least a good slug of it. And technology can be a really good answer for that if it's the right type of, you know, really sophisticated technology that can solve problems in meaningful ways.
Great, thank you, Sean. And Carol, turning to you as we sort of think about what's coming next in terms of technology within the reinsurance space. What are you looking out for at KBRA and hoping to see from the industry?
Well, I think a couple of things that I hear, you know, companies talk about. I think we need to get beyond this whole. I think we've done a good job at it so far, but we need to continue along this path of using the past to predict the future, because the future is changing and risk is changing at a very rapid pace. The pandemic proved that, where we all had to, you know, sort of stop, regroup, and figure out how we were going to do our jobs when we couldn't go into the office. So I think we can use technology to help us get a better view of the future, of that emerging risk, leveraging off of what we know from the past. And I think we need to get better as an industry of accepting different methodologies to view the same risk. So I hear from ceding companies sometimes that they've licensed some particular software that's helping them really understand their risk better, make their operations better. But they can't use it beyond, you know, their own little internal usage, because it's not widely accepted across the marketplace. And it could be something that they built or they bought, but it really doesn't matter. We need to get over that mindset. And have a way of vetting all these different things so that we can blend things to get the best view of what that risk is and how we can efficiently match up capital to that risk. And another thing that I think needs to happen, and I see it more in non-insurance venues than I do within the insurance industry, but we need to have a way, and technology can provide some of this, of taking disparate internal, external views on a particular data point, issue, and allow the company to quickly, you know, resolve that issue in real time. And that goes back to the, you know, my comments on underwriting can't have a view on risk that once the claim comes in, the claims department says, oh no, that wasn't the risk at all. There needs to be a way to resolve that quickly. I also think the industry hasn't done, certainly not the way a Google or an Apple or an Amazon has done, but we need to get to using unstructured data more. I think some of that's being done on the claim side, but we need to further that along. Just in order to make the process more efficient and have a singular view, the best possible view that we can of this. I think that's where the industry needs to go. I think there's a lot of people working on that, and hopefully we'll get there sooner rather than later.
Thank you, Carol. Yeah, there's certainly a lot to do there in that area. And it's interesting that you mentioned unstructured data as well, because obviously that's potentially a huge opportunity. Claude, turning to you, as we sort of look to the future, what do you think the next phase of the industry's transformation looks like?
Yeah, I mean, I think, I guess two thoughts. One is a pretty certain thing, and the other less so. The first would be that's more certain that as so many different approaches and entrants, including the insurtech players and all the current marketplace participants, continue to innovate, I think that certain themes of new innovative capabilities will become more evident, because we're still, as Sean said, in the early innings of some of that, but we're progressing. And I think people will start to coalesce around those things and focus on those things and make sure that they have their own version of that they have that capability, and that will just help move everything forward. So I think some of those themes of innovation and new capabilities, if you will, or enhanced capabilities, will start to emerge. I think the second thing that is certainly possible to happen is you will have a larger entrant or two into the marketplace, so sort of an outside stimulus into the marketplace that will do business in their own way, that addresses some of these things we've been talking about, the simplification or the desire to, maybe invest a very large sum of money that might be money losing in the short run, but that compels and kind of pushes in that typical outside stimulus sort of way, the industry to take notice of that and address it and have others maybe follow suit. And then that provides its own catalyst for change effectively.
Great. Thank you, Claude. Sean, any final words from you on sort of where you see technology taking the reinsurance industry? Perhaps look 5 years ahead into your crystal ball.
Yeah, I think maybe two things, sort of one fundamental, maybe one a little tactical. Just fundamentally, I think that the notion of having defined renewal seasons where everyone is buying basically a couple of times a year will be radically different in a few years for good reason. So there'd be more opportunities to transfer risk more often, and technology will be a big enabler of that. I think that's going to be healthy for all sides of the market. And maybe more tactically, I think that things like how portfolios are structured and then purchased will be dramatically different. You can imagine a world where I'm a portfolio company, I'm advised by my broker in terms of how much capacity I need to buy and how much I want to keep on my P&L versus paying out in capital. But what happens in the middle should be a really good technology problem to solve. The market on the supply side should have very strong views of where they want to participate on a stretch. And things like dynamic layering of programs, that should really be something that the market can do, powered by technology. And I think you'll see things like that will begin to emerge. And it kind of all starts with, Nexus, hubs of trading capabilities that are powered by, modern trading technologies that exist in many capital markets today. So that's kind of what we see as the next couple of years down the road.
Great, thank you, Sean. So with that, we have run over, I'm afraid, and we aren't going to have time for audience questions, unfortunately, today. But I'd just like to say a big thank you to my three panelists. We've got Sean Bourgeois from Tremor Technologies, Claude Yoder from Lockton Re, and Carol Pierce from KBRA. Thank you all for participating in this. Thank you for your contributions. I think that was a very good discussion. Thank you to our audience as well for tuning in. This is now the last session of Prospectus 2021, so thank you for supporting the event. You'll be able to watch every session on demand, and we'll be reminding you in various articles and emails to make sure you can get yourself some evening reading and watching. So thank you again, panelists. I really appreciate your time, and thank you to everyone for watching the event.